Okay, now we know compounding your money is the secret to building wealth. We know that. But that raises the obvious question. How do we actually do it? Like, where does the money go? And the answer is in three things you've probably heard of, but you've never cared to even research or had it explained to you properly. These three things are stocks, index funds, and ETFs. So that's what we're going to talk about today. Starting with stocks. So, stock is literally just a small piece of ownership in a company. When a company goes public, meaning they list themselves on the stock market, they split the company up into millions of tiny pieces and sell those to the public. Those pieces are called shares. When you buy one, you're an owner, a tiny one, but an owner nonetheless. So what does that mean for you? Two things. First, if the company grows and it becomes more valuable, your piece of it becomes more valuable as well. That's how people make money on stocks. Second, some companies take a portion of their profits and pay it out directly to their shareholders. That's called a dividend. So you're just getting paid for holding the stock. The thing about investing in one singular company is that it gets risky. Take Google, for example. Back in late 2021, the stock was riding high around $149 a share. Then it crashed all the way down to $86. So that's a 42% drop. And it didn't even recover to where it started until early 2024. That's 2 years of sitting in the red. But flip it around, if you caught Google at its lows in early 2025, around 148, that same price that it dropped from before, and you look at it today, you're looking at 123% return. So you're more than doubling your money since last year, around March. So that shows that individual stocks are high risk, high reward. On to indexes. So now that we see how volatile a single stock can be, let me introduce you to the index fund. Think of it like a basket of stocks grouped together for a specific reason. Instead of betting on one company, you own a tiny piece of hundreds or even thousands of companies at once. That's how it manages risk. If one company tanks, the others can carry it. A good example of this is the Vanguard 500 index fund. This tracks the S&P 500, which is the 500 largest companies in America: Apple, Google, Amazon, Microsoft, etc., all in one basket. Now, it's not perfect because at the end of 2021, this fund was sitting at around $439 a share. By the bottom, it had dropped all the way to $330, about a 25% drop. And this didn't recover until 2023. But today, it's sitting around $643. So if you held it throughout that entire time from 2021, you're looking at a 46% gain from where you started. And on top of that, a price appreciation, it pays out a dividend income. So you're getting paid while you hold it. One thing worth noting is that index funds do have an expense ratio, which is just a small annual fee, typically around like 0.5%, 1%. 1% is typically kind of high. Also, the Vanguard 500 fund does require $3,000 minimum to even just get in. And also, I want it to be noted that I am not a financial advisor. I'm not recommending these ETFs or these stocks. I'm just giving them as examples. Now we can get into ETFs. So we just talked about the index funds, but there's another way you can invest in that same basket of stocks, and that's called an ETF, or an exchange traded fund. And the easiest way to explain it is this. It's basically the same thing as an index fund, but it behaves like you're trading a stock. Index funds give you a price for the day. So the closing price of that day is the price that it costs to get into it. ETFs, on the other hand, are constantly fluctuating throughout the day, just like a stock. So if you see the market dipping in the morning and you want to jump in at a lower price, you can do that with the ETF, but you can't with a traditional index fund. A perfect example of this is VOO, which is also the Vanguard 500 fund. It's just the ETF for it. It's literally the same basket, but the big difference is there's no minimum buy-in since you can buy fractional shares, and that expense ratio is much lower when you're trading the ETF rather than the index fund. VOO tends to be the most basic and beginner-friendly ETF that I ever see. Like whenever I look up anything or do any research, that's the benchmark and that's what everybody's trading. Some of my professors in my old finance classes, they definitely were saying that's the one. Also, not advice. That's just the benchmark that we're using. As for my situation, my job currently doesn't even offer a Roth IRA or anything like that, so I can't really invest into index funds comfortably for myself. Therefore, I do just invest into my ETFs, and then I pick a few stocks here and there. I do want to get better at picking stocks, and I do want to share that information because there's obviously a lot of research that goes into it. With that being said, I do believe that the future of my investing is probably going to rely heavy on index funds later down my life, and probably less on individual stocks, because the whole point is just to remain as risk averse as possible and try not to risk anything and limit the amount of money I could have in my own retirement. So with that being said, I thank you guys for listening. Please stick around. Please ask anything. because I do want to get better at my research and build a bigger platform and something for me to do on here and journal my entire wealth journey and financial strategies that I develop over time.